The stock market has risen and there doesn't seem to be an end in sight. The central banks have successfully devalued the currencies globally in concert. Which stocks have benefited the most over the years? You came here for the truth, so let me unveil that for you. Today we're going to look at the stock market. I want to address other indicators. Let's begin. This is a listing of the top 10 contributors of the S&P 500 rise since Trump's election. I want you to focus here on the contribution to the S&P 500 performance. And you'll see that there are Apple, Microsoft, Amazon, Alphabet, Facebook, and others. These are the top 10. We've covered them before, but just to address other companies, you have Boeing, you have Walmart, JP Morgan, Bank of America, and NVIDIA. They have all done very well, with NVIDIA obviously being the best performer since April of 2016, rising over 200%. You look at these PE ratios and you realize that they are, for the most part, unsustainable, particularly when you look at this Amazon being excessively high in the dot-com bubble levels. Why have these stocks risen? That's the question that is continuously being asked. And the truth is that the G5 plus Swiss central bank balance sheets have been rising. Look at this. $20 trillion approximately has been printed. This is going back since basically the dot-com bubble. But most of that was after the financial crisis. And you look at this, I mean, we got the Fed, ECB, the BOJ, Bank of England, Swiss Bank, and the PBOC all printing. And they're not alone. There are more central banks doing this. But these are the, let's say, biggest offenders. We're talking about $20 trillion plus that is on the books. That doesn't factor in the whole $16 trillion that the Fed printed and gave to institutions all around the world. That is literally not accounted for. So imagine if all the central banks were doing this. We don't know how much is out there, but I can tell you this. These central banks have been printing money and they've been buying either toxic assets, bonds, equities, ETFs, and more. And now, real estate. That's what's happening here. The central banks are becoming the biggest shareholders, bondholders, toxic garbage holders, and real estate holders. And as an individual, that concerns me because these central banks do not work for the people. We know that. We know that all of these institutions operate as corporations. They are there to make a profit. They are semi-private, or what I call quasi-government. They don't actually work in the benefit of the people. There is no transparency to their decisions. And there is no authority that can overrule the decisions that they make. That, to me, says a lot. Yet, they are able to issue the currency of that particular country, print as much of it as they want, and in this case, become the biggest holders of everything. That's concerning to me. But to the average person, doesn't seem to be concerning them one bit. Only 4 times in history has more time passed without a 5% correction. That's not normal. And many people would just ignore this fact. But I just want to address the fact that this is not normal. You need to have volatility. It's important. It just happens. That's a natural event. You don't want that to happen. But it's just good that there are natural market forces occurring in the markets. That doesn't happen anymore. So the market is basically relying on a continuously increasing level of quantitative easing measures. That's what's happening. And you cannot do this forever. The central banks around the world are destroying their currencies. And you as an individual, if you live in a particular country, you're forced to use a particular currency and they're destroying it. Talk to anybody that lives under hyperinflation or heavy inflation. And I have done this many, many times. Different countries that are either previously under heavy inflation, hyperinflation, or you know, a different state of inflation that is significantly higher than many countries are in today. You'll find that they tell you relatively the same thing, and that is, it doesn't matter how much money you're making in your interest on your assets. Your currency is being devalued so fast that it doesn't even work itself out. Like, I'll say this. If the central bank is engaging in some sort of quantitative easing program and the currency is being devalued against other currencies globally, you will have a problem where, let's say, 50% or even 25% inflation. Okay, but you bought assets to try and keep up with that. Oftentimes, depends on the situation, but oftentimes your assets, so let's say you bought into the, real estate, for example. Will the real estate rise by 25 to 50%? I mean, it's possible for sure, but probably not. That's what I have found anyway when asking people, not just looking in the history books. The overall fact is that they end up sinking. No matter how much money you have, no matter how many assets you have, as long as they're willing to devalue your currency, you're going to be in trouble. Okay, quickly. Shiller PE ratio, I always cover this. I think it's just one of many indicators. Many people put a lot of faith into it, whereas I simply like to look at it as just one of many indicators. Right here, 31.51. And now only one other point in time where the PE ratio has been higher, and that is the dot-com boom, when things went absolutely insane. But what I found out about the calculation of the PE ratio, and I think this is actually, I need to look into it more because it doesn't make any sense. The fact that you have particular PE ratios that go over a level, which I believe was 80, they wipe them off. So if they're too high or too low, they just get canceled out. And I don't believe that that is a good way to do things, especially if they're big stocks. Maybe if they're a small stock and somehow they're being thrown off, okay. But if we're talking about, billion-dollar stocks here, that's not a good thing. That skews the whole system and makes the PE ratio look a lot lower. And I believe it was nearly double, if I'm not mistaken. I have to do a video about that, and I will in the near future. Okay, stay tuned for that. No alternative to riding financial bubbles. Look at what's happened. I mean, you had the dot-com boom, right? The real estate bubble, the bond bubble today, and I would argue that we are, in fact, in the equity bubble again. But let's just stick to bonds for now. What's going to come next? Is it commodities again? Is it real estate? Is it looking at cryptocurrencies? I mean, what's the next bubble that trillions of dollars are going to find their way into? That's what we need to know, because ultimately they are going to pop these bubbles, and that money needs to go somewhere. It's a wealth transfer. It doesn't just disappear, it goes somewhere else, usually into the pockets of guys like Rothschild. But we'll see. We'll see where it goes. I'm really, really curious to see how this all takes place. If you found this video informative, please give me a thumbs up. If not, give me a thumbs down. I'm probably the only YouTuber out there who actually asks for a thumbs down. If you found the video informative, I know you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. If you go over to Amazon, they have a look inside feature. It's going to allow you to flip through the pages of the books to see if you like them. Take care.